So here's the question everyone asks. Can this happen to wealthy developed nations like the United States, United Kingdom, Germany, or Canada? The uncomfortable answer is, it's complicated, but elements of it absolutely can. Let's look at the facts. The United States has a national debt exceeding $34 trillion. That's over 120% of GDP. Japan's debt is 260% of GDP. Italy's is 140%. These are numbers that would terrify economists if we saw them in emerging markets. So why haven't these countries collapsed? There are several critical differences. First, these countries borrow in their own currencies. The US borrows in dollars. Japan borrows in yen. This means they can theoretically always print money to pay debts. Countries like Argentina and Lebanon borrowed in foreign currency, dollars or euros, which they couldn't print. That's a massive difference. Second, these currencies are global reserve currencies, especially the dollar. Central banks and investors around the world hold dollars as safe assets. This creates constant demand for US debt even at low interest rates. As long as this confidence remains, the system works. Third, these economies are enormously productive. They have strong institutions, rule of law, property rights, innovation capacity. This generates tax revenue and economic growth that can service even large debts. But, and this is crucial, none of these protections are permanent or absolute. If confidence ever breaks, if investors decide US bonds or Japanese bonds are no longer safe, the entire system can unravel remarkably fast. We saw hints of this in the UK in 2022 when bond markets revolted against the government's fiscal plans, forcing a complete reversal within days. The real risk for wealthy nations isn't sudden default. It's slow-motion crisis through inflation. When debt becomes unsustainable, governments face a choice: explicit default, which destroys credibility forever, or implicit default through inflation, which slowly erodes the value of money. Inflation is a hidden tax. If the government owes $10 trillion and inflation runs at 5% per year, the real value of that debt shrinks without technically defaulting. But your savings shrink too. Your salary's purchasing power declines. You're poorer even though the numbers look the same. This is already happening in many developed nations. Inflation rates that seemed impossible a few years ago are now reality. Debt keeps rising. Interest payments consume larger portions of budgets. Social programs become unaffordable. The middle class gets squeezed. The bankruptcy of wealthy nations won't look like Lebanon or Argentina, but it could look like decades of declining living standards, eroded savings, reduced opportunities, and generational debt that our children inherit. So, what can you actually do with this knowledge? How do you protect yourself if your country is heading toward financial trouble? First, diversify your assets beyond your national currency. This doesn't mean panic or paranoia. It means being prudent. Hold some savings in strong foreign currencies like US dollars, Swiss francs, or euros if you're in an emerging market. If you're in a developed nation, consider assets that aren't purely currency dependent. Second, invest in real assets that hold value across currency crises. Real estate in stable areas. Commodities like gold or silver. Stocks in companies with international operations and hard assets. These maintain value when currencies collapse because they're tied to physical reality, not government promises. Third, develop skills that are valuable anywhere. In every bankruptcy crisis, the people who survive best are those with portable skills. Medical professionals, engineers, skilled trades, technology workers. These abilities transcend national borders and currency fluctuations. Fourth, build networks internationally. Having connections, opportunities, and options in other countries provides insurance that's impossible to overvalue when crisis hits. This doesn't require being wealthy. It requires being strategic and forward-thinking. Fifth, stay informed about your country's fiscal situation. Watch debt-to-GDP ratios. Monitor bond yields. Pay attention to currency movements. These aren't abstract numbers. They're early warning systems for your financial security. Here's what you need to understand at a fundamental level. Countries going bankrupt isn't some rare historical anomaly. It's a recurring pattern throughout human history. It's happened to over 70 nations in the last 50 years alone. And the factors that cause it, excessive borrowing, political short-term thinking, denial of reality, are present in many countries right now. The difference between people who are destroyed by these crises and people who survive them often comes down to awareness and preparation. Those who see the signs early and take protective action preserve their wealth and opportunities. Those who trust government assurances and keep all assets in vulnerable positions lose everything. I'm not saying panic. I'm not predicting imminent collapse. I'm saying be aware, be educated, be prepared. Because whether it's 10 years from now or 30 years from now, these patterns repeat. And when the next major sovereign debt crisis hits, you want to be the person who saw it coming. If this video opened your eyes to how fragile national finances really are, subscribe to this channel. I break down complex economic topics every week so you can make informed decisions about your financial future. Stay educated, stay prepared, stay ahead.
Free digits. That's all it takes to shatter the illusion. The noise of the market is deafening, hiding the collapse. Paper promises are being torn apart. It's a quiet funeral for an era that has already ended. While the world sleeps, the reality sets in. It is time to rewire how you think about value. This is what nobody is talking about. The truth is solid.
In 2009, Greece revealed something shocking. They had been lying about their finances for years. The government deficit wasn't 3% of GDP as reported. It was actually 13%. They had hidden the true numbers using complex financial tricks. And just like that, Greece went from a trusted Eurozone member to a bankruptcy risk. What followed was a crisis that nearly destroyed the European Union itself. Greece owed over 300 billion euros. Their debt-to-GDP ratio was 120% and climbing. But unlike Argentina, Greece couldn't just devalue its currency because it used the euro. It shared that currency with 18 other countries. This made the crisis far more complicated and far more dangerous. Bond yields exploded. Greece couldn't borrow money at affordable rates anymore. Without borrowing, it couldn't pay government salaries, pensions, or basic services. The economy was weeks away from complete collapse. Banks would fail. ATMs would run dry. The European Union and International Monetary Fund stepped in with bailout packages totaling over 260 billion euros. But these bailouts came with brutal conditions called austerity measures. Greece had to slash government spending by 20%. They cut pensions by 40%. They raised taxes dramatically. Public sector salaries were reduced by 30%. Unemployment programs were gutted. The result? Economic devastation worse than the Great Depression in America. Unemployment hit 27%. Youth unemployment exceeded 60%. An entire generation couldn't find work. GDP contracted by 25% over 5 years. Imagine your country's economy shrinking by a quarter. Businesses closed everywhere. Suicide rates spiked. Healthcare collapsed as hospitals ran out of basic supplies. Pensioners who had worked their entire lives saw their retirement income cut in half. They couldn't afford medication. Families moved back in together because no one could pay rent. The brain drain began as educated young Greeks fled. And the political fallout? Massive protests. Riots in Athens. The rise of extremist political parties on both the far left and far right. Democracy itself was strained as the troika of creditors essentially dictated Greek economic policy. But what happens when a country doesn't get a bailout? When there's no one to rescue them? That brings us to Lebanon. Lebanon's collapse between 2019 and 2022 is one of the most dramatic economic disasters in modern history. The World Bank called it one of the worst financial crises since the 1850s. For decades, Lebanon operated under a dangerous illusion. The country imported nearly everything. It produced little. It ran massive trade deficits year after year. To fund this lifestyle, Lebanon's banks offered incredibly high interest rates on deposits, up to 15%. But here's the scam. It was a nationwide Ponzi scheme. Early depositors got paid with money from new depositors. By 2019, the system was collapsing. Banks couldn't access dollars anymore. Lebanon defaulted on its debt in March 2020, owing over $30 billion it simply couldn't pay. And because Lebanon didn't have the geopolitical importance of Greece, no one came to rescue them. What followed was complete economic annihilation. The Lebanese pound, which had been pegged at 1,500 to the dollar for 22 years, collapsed. At its worst, it hit over 100,000 to the dollar. Your life savings of $10,000 became worth $100. Pensions became worthless overnight. Salaries that seemed middle class became poverty wages. Banks imposed severe capital controls. You couldn't withdraw your own money. The country lost electricity. Power plants shut down because there was no money for fuel. Hospitals couldn't function. Medicine disappeared. Bread lines stretched for blocks. Over 80% of the population fell into poverty. The professional class fled. Doctors, nurses, engineers, teachers left by the hundreds of thousands. Banks were attacked. Some desperate people held up banks at gunpoint just to access their own frozen savings. Society began to fracture. And here's the most chilling part. The government simply collapsed into paralysis. Lebanon still hasn't recovered. It may never fully recover. This is what unmanaged bankruptcy looks like.